The silver market is splitting in two. How is this so? Well, the real price of silver is in Shanghai, and the fake price of silver is in New York. Silver traders cannot buy silver in New York and ship it to China, and that's usually what happens before a system falls apart and the markets fracture. That's what's happening in silver. Next, it will happen in gold, and then the dollar will be dead. Bank of Japan faces familiar dilemma as Iran conflicts stirs inflation. The yen is Japanese bonds, so the weaker bonds are, the weaker the yen is. Japan is very heavily dependent on oil that goes through the Straits of Hormuz. If they don't get it soon, the purchasing power of the yen is going to collapse, and they're going to be forced to raise interest rates because that's all they know how to do. Copper is already at its all-time highs, or very, very near them. We're at $5.72 a pound here, and we've never been this high before, but this also looks kind of, nickel Armageddon-y. What is going on with the aluminum delivery situation? As we led up to nickel Armageddon, the prices of aluminum were also spiking here. So while gold and silver appear to be calming down for now, it's not going to stay that way for much longer, because it looks like the Straits of Hormuz are going to continue to be closed for the next few weeks at least. There are still missiles going over my head here in Israel, though no big impacts where I am. And while we're at it, we're going to talk about the silver market apparently splitting in two between New York and London on one hand, and China, meaning Beijing or Shanghai, on the other hand. The silver market is splitting in two. How is this so? Well, people look at the SGE, I think it's the Shanghai something, I forgot what it stands for. It's the Shanghai Exchange, Shanghai Gold Exchange, is that what it stands for? We have these high premiums in Shanghai of silver, about 15.16% as of the last data. And that's pretty high. It's not unprecedented. They've been there before, but very rarely. And so what people like to say is that the real price of silver is in Shanghai and the fake price of silver is in New York. Well, that's not exactly what's happening, because you can still get physical silver for New York prices in the New York market, which is basically the Western market. It's not a fake price. It's just a different price. What it really means is that the two silver markets are splitting apart.
The real story isn't calm metals. It's a market quietly breaking into two price realities. As Rafi Farber points out here, a 15.16% Shanghai premium isn't just noise. It signals regional demand overpowering global pricing mechanisms. But if New York still delivers physical at lower prices, the disconnect suggests capital controls or logistics, not manipulation alone, are driving divergence. For investors, that means price discovery is fragmenting, which historically precedes volatility spikes rather than stability. Next, Rafi Farber unravels why arbitrage isn't closing this gap.
I split Robin's arrow in twain!
Because if they were integrated, then people would buy silver in New York, sell it in Shanghai, and profit the difference. That premium, they would arbitrage it. That's what markets do when they are functioning in an integrated way. The fact that these premiums are stubborn and they won't go away means that for whatever reason, silver traders cannot buy silver in New York and ship it to China. Maybe it's regulatory, maybe it's something else. But whatever it is, these markets are splitting apart into two different markets. And here you have the long term, the longest term that the chart goes back on gold charts are us. You can see that we are at 15.16%. We have been here before once during the silver crash of late 2011 after the $50 high or the $49 high back then. But we've never really been in this area for a prolonged, sustained period of time. But if we do, if this premium doesn't go away, then basically it's saying that the silver market has split in two, and that's usually what happens before a system falls apart. The markets fracture. That's what's happening in silver. Next, it will happen in gold, and then the dollar will be dead. But it's already happening in one of the monetary metals, so this is a warning that whatever is on the way in an endgame sense is definitely coming.
If arbitrage isn't happening, the market isn't functioning the way textbooks say it should. As Rafi Farber points out here, a persistent 15% premium since levels last seen after the 2011 silver peak signals structural blockage, not temporary inefficiency. But jumping from market fragmentation to dollar collapse skips key realities, capital restrictions, shipping costs, on geopolitical friction, often distort flows without ending systems. For investors, this means volatility and regional pricing gaps could widen before any systemic reset narrative plays out. Next, Rafi Farber discusses what this fracture could mean for gold.
Bank of Japan faces familiar dilemma as Iran conflicts stirs inflation. Bank of Japan. The reason I'm reading that headline, and that headline I think is from the Wall Street Journal. The subheadline is markets are pricing in a 60% chance of a rate hike at its next meeting in April. The implication of that title, of that headline, is that the Bank of Japan is going to try to raise rates to stabilize the yen. But if you look at this medium-term chart of the yen versus interest rates, Japanese interest rates, in the blue you have the 10-year interest rates. The higher it goes, the higher the yield. You can see, generally speaking, though it's not a perfect correlation here, the higher the yield goes, the weaker the yen goes. The other line, the not blue one, I don't know what color it is, but it doesn't matter. That is the yen rate per dollar. So the higher it goes, the weaker the yen is. So you can see the higher yields go, the weaker the yen is. And I've made this point over and over again here. The yen is Japanese bonds. So the weaker bonds are, the weaker the yen is. And so a rate hike cannot strengthen the yen, as it never has in the last 6 or 7 years, because the yen is so heavily dependent on the value of the bonds that back it, because of all the QE that's been taking place since Abenomics began in 2013.
Markets are betting on a rate hike fixing the yen, but the data suggests the opposite dynamic. As Rafi Farber points out here, rising Japanese yields over the past 6 to 7 years have coincided with a weaker yen, not strength. That flips the usual narrative, because Japan's massive QE since 2013 ties currency value directly to bond stability, not just rates. For investors, this means April rate expectations could trigger more volatility in FX and global carry trades instead of stabilization. Next, Rafi Farber shows why this bond-yen link becomes dangerous.
The yen and the Japanese government 10-year bond are welded together at the hip. They are Siamese twins. Japan is very heavily dependent on oil that goes through the Straits of Hormuz. If they don't get it soon, the purchasing power of the yen is going to collapse, and they're going to be forced to raise interest rates because that's all they know how to do. Little do they know that raising interest rates will only hurt the yen even more, because the yen and the Japanese government bond are the same thing. Here's where the yen is now. It is testing the final support zone hit in 1990. You can see here we have a triple top over here, but triple tops very rarely hold. And we're going to break through this. And once we break through this, there is basically no support until we get to like 250 or something like that. This was a huge spike up for the yen over here in the early 80s, in the mid 80s, and a spike down for the dollar. But we're breaking that now, and it's been a long time coming, since 1990. The yen is going to collapse, and with it, the rest of the Western monetary order as we know it. And what is Japan planning to do about this? Nothing! Absolutely nothing!
Nothing! Absolutely nothing!
A currency testing a 30-year support level, while policymakers double down on the same playbook, is a serious warning sign. As Rafi Farber points out here, Japan's dependence on imported energy through Hormuz collides with a yen already near 1990 breakdown levels. But predicting a straight collapse to extreme levels ignores intervention history. Japan has stepped in before when volatility threatens systemic stability. For investors, this setup raises risk in global bonds, FX, and export-driven equities tied to yen weakness. Next, Rafi Farber discusses what Japan is, or isn't, planning next.
Japan has no plan to dispatch naval vessels to escort, this from Reuters actually, to escort vessels in the Middle East, Prime Minister Sanae Takaichi said on Monday after U.S. President Donald Trump called on allies to protect tankers traversing through the Strait of Hormuz. We have not made any decisions whatsoever about dispatching escort ships. We are continuing to examine what Japan can do independently and what can be done within the legal framework, Takaichi told Parliament. These people are very different from what they used to be prior to World War II, prior to getting involved in nuclear war with the United States. They have lost their spine. They have no ability to fight for their own interests anymore. And that's going to change when the dollar dies. The Japanese are going to come back to themselves, and they're going to be more of a fighting nation. It's been pretty embarrassing for them since 1945, and I hope they get their will to live back because they've also stopped reproducing and they've got to get on that too. All in all, the money metals may be quiet right now, but watch the base metals and watch what's happening in Hormuz. How much longer can it stay closed before chaos breaks out? My bet is not that much longer at all.
Energy security risks are rising, yet policy response remains strikingly passive. As Rafi Farber points out here, Japan's refusal to escort tankers through Hormuz highlights a deeper vulnerability for an economy reliant on imported energy flows. But framing this purely as political weakness ignores structural constraints. Constitutional limits and alliance dependencies have shaped Japan's posture since 1945. For investors, prolonged disruption here feeds directly into inflation, currency pressure, and industrial margins, especially for exporters. Next, Rafi Farber discusses why base metals may react before markets do.
Copper is already at its all-time highs, or very, very near them. We're at $5.72 a pound here, and we've never been this high before, but this also looks kind of, nickel Armageddon-y. I think this point over here, this spike, which was at the time an all-time high for copper in March 7th, 2022. There was also a copper spike. It affected copper and aluminum and all other metals as well. But if we have copper already at all-time highs and another futures trading fiasco in front of us due to the shutdown of the Straits of Hormuz, who knows how high copper could go. But if you look at the same thing that I just showed you in aluminum, that the real price of aluminum is at all-time lows, it's the same with copper. The real price of copper is at all-time lows relative to gold. The problem with the system is the fiat money. It is not necessarily the supply of these metals. It's the problem that how it will affect the main credit instrument, which is the US dollar, which of course eventually will die. Could this precipitate it? Could Straits of Hormuz being closed precipitate the end of the dollar? Very much so. We'll see what happens. You got to stay calm and not assume that any single cause is going to be the end game, but one of these days it will be. We just don't know what it will be until it happens.
All-time highs in copper are being treated as strength, but the underlying signal may be far less reassuring. As Rafi Farber points out here, copper at 572, while still historically cheap, versus gold suggests currency distortion rather than pure demand strength. The March 7, 2022 spike shows how quickly futures markets can break under stress, yet investors often ignore how leverage amplifies these moves. For portfolios, this raises risk in cyclicals and commodities tied to liquidity shocks, not just growth narratives. Next, Rafi Farber shows how this stress is already surfacing in aluminum.
What is going on with the aluminum delivery situation? Well, I checked it out at the CME, and each aluminum contract covers notionally 25 metric tons. And so you check the inventory at the CME, you get these numbers. 1,339 metric tons are warranted, meaning they are for sale against contracts. If you divide that by 25, you get 53, I think. Yes, you get 53. So you have 53 contracts of physical aluminum are available on the CME vaults all around the world. And look at these numbers. You have the current delivery figures for the amount of contracts delivered as of March 12th. And I think that is still up to date to today. It's 111. So 111 warranted contracts warrants have changed hands, where there's only 53 contracts worth of aluminum available. So these warrants, they are changing hands, I guess, more than once, going back and forth, maybe being double counted or something. I don't know exactly how this works, but the amount of deliveries of aluminum versus the amount of aluminum available is extremely tight. However, it's being counted, and I can't really tell you. I'm not an expert on how the maybe fractional reserve system in the CME actually works, but these numbers look pretty bad. How much aluminum goes through Hormuz, the straits of which are still shut by Iran in their threats due to mostly insurance issues?
When deliveries exceed available supply, something in the system isn't adding up. As Rafi Farber points out here, 100 F1 contracts delivered against just 53 available highlights how paper markets can stretch beyond physical limits. This isn't unusual in futures markets, but it becomes risky when confidence drops. and more participants demand actual delivery. For investors, that tension can trigger sudden price spikes or forced unwinds, especially if geopolitical disruptions tighten supply further. Next, Rafi Farber unravels how aluminum prices are already reacting to this pressure.
So primary aluminum production outside of China, the Gulf, is responsible for 8% of this. It's not the biggest portion of the market. China is, and you have Europe, including Russia, but it's the second biggest after that. So Gulf producers accounted for 23% of Western output in 2025 for aluminum. So there could be a Alumageddon pretty soon. We'll see exactly how the numbers work out. Watch the aluminum companies and watch for any kind of domino effect on the futures exchanges that begin with aluminum. So if you look back at Nickel Armageddon on March 7th, 2022, this is aluminum. This is not nickel, this is aluminum. But look what happened to aluminum during Nickel Armageddon in 2022, March 7th. We went up to about $4,000 per ton here at the high on March 7th, 2022. And then once those trades were reversed and justice was served, of course, if somebody goes bankrupt or if a big company goes bankrupt, you got to reverse the trades because you can't really hurt those people. That would be bad. But you see here that the aluminum prices are already starting to act as if a nickel Armageddon or an Alumageddon is coming.
Markets rarely warn you twice, but aluminum may be flashing a familiar signal. As Rafi Farber points out here, Gulf production accounting for 23% of Western output creates a choke point if Hormuz disruptions persist. The March 2022 spike to $4,000 per ton showed how quickly prices can detach when liquidity breaks, yet markets often dismiss early moves as noise. For investors, this setup raises risk in industrial supply chains and margin-sensitive sectors before headlines catch up. Next, Rafi Farber discusses how close we may be to a broader futures shock.
We're already at about $34.22 a ton, and you can see as we led up to Nickel Armageddon, the prices of aluminum were also spiking here. So we could be in the situation right now, which means we might be weeks away from some kind of crash in the futures markets, beginning with aluminum. Now, if you look at the real price of aluminum in gold terms, we're at an all-time low, actually, in aluminum prices. And this just demonstrates, the only thing it demonstrates is that the problem isn't the aluminum supply, the problem is the credit itself that is dying, and that requires huge amounts of supply going through in order to keep its purchasing power looking better than it actually is. But in terms of the real price of aluminum, it couldn't be any cheaper.
Prices rising in dollars while collapsing in real terms is the kind of contradiction markets often ignore. As Rafi Farber points out here, aluminum near 3,422, yet at all-time lows versus gold, suggests currency debasement is driving the narrative more than scarcity. The comparison to 2022 implies a potential futures shock, but not every spike ends in collapse. Liquidity conditions and central bank responses matter. For investors, this signals hidden risk in pricing signals across commodities and equities tied to them, tied to